Thank you, Tom. So the Chancellor clearly is in a very difficult situation. The deficit may well be back down to where it was before the crisis, but the government wants to reduce it further because it's concerned about the size of debt, which is still much elevated on pre-crisis levels. So to do that, he's in a situation where after 7 years of austerity, further tax rises, further benefit cuts, and further public service cuts are planned. Doing more is clearly difficult. He's also trying to do this in the context of minority government. He's trying to do it in a context where we don't know the details of the Brexit deal that we will eventually have, and we certainly don't know what effect that Brexit deal will have on the UK economy and on the public finances. Economists might be confident that the Brexit deal will lead to GDP being smaller than what it otherwise would have been had we stayed in the EU. There's great degree of uncertainty over how big that effect will be. So given that situation, what's the Chancellor going to do? Well, I'm going to start by looking at what previous Chancellors have done at similar moments in time, talk about some options for tax rises, and then once I've decided that they're perhaps not very likely, I'll go on and talk about sets of giveaways that might be possible. What tax cuts, what benefit increases, and what public service increases might you expect the Chancellor to be at least thinking about at the moment? So firstly, this is the first fiscal event of a new Parliament, and we can look to see what previous Chancellors have done in the first year after general elections. And if we take the 2015 election, the Conservative government was elected, and in the first 12 months, they announced policies which net would increase taxes by about £13 billion in the current year. So that's increases in tax from insurance premium tax, council tax, and the new dividend tax. So Mr Osborne announcing a fiscal takeaway, a tax rise after the election. And in doing so, he was following a pattern that other Chancellors had done as well. So Mr Osborne himself in 2010, when the coalition government was elected, announced a net tax rise in that first year. Labour in 2005, 2001 and 1997 also announced big tax rises in the first year after election. And in fact, the last time a Conservative government was re-elected back in 1992, you get the biggest set of tax rises over this period in that first year. So perhaps Mr Hammond would look at this, see the opportunity to announce a significant tax rise in order to help the public finances. But of course, these were all majority governments. That's not a luxury that Mr Hammond has, and therefore perhaps a significant tax rise of this kind of scale is highly unlikely. So another thing we can look at is how Chancellors have responded to when the public finances have changed. What have they tended to do when the outlook for the public finances has got better or got worse? And for this, I'm going to focus on the period since 2010, since the OBR started producing forecasts. And on 5 occasions, the Chancellor has stood up and been able to say that the underlying public finances now look stronger than he thought in the previous fiscal statement. And that underlying improvement in the public finances on average was approaching £9 billion. So what did Mr Osborne and Mr Hammond choose to do in this situation? Well, they choose to set out policies that in the long run would give away about £6 billion of the improvement. So they spent most, but not all, of the improvement in the public finances that they were enjoying. And in the short run, there was a little bit of a giveaway too. Now, the bad news is that on 10 occasions, so twice as often, we've heard the Chancellor have to stand up and admit that the outlook for the public finances is worse rather than better. And the bad news is that the average deterioration is also much, much greater. It's slightly over £15 billion. So how did Mr Osborne and Mr Hammond choose to respond to that? Well, in terms of long-run policy, they did announce a takeaway, but only for a minority, only offsetting a minority of the deterioration. So £15 billion worse outlook for the public finances, offset by just £5 billion. The majority was just allowed to feed into greater borrowing on an enduring basis. And what about in the short run? Did we get a takeaway that was immediate? No, we got a short-run giveaway. Now, I'm not saying that the right response is always to be symmetric here. It could be that these are the right sets of responses for those moments. But clearly, over the longer term, we can't have a situation where whenever the public finances get better, we choose to spend most of the money. Whenever the public finances get worse, we choose to allow borrowing to increase for the majority of the extent of that deterioration. So what might Mr Hammond do? Well, if he was to announce increases in tax, there are lots of tax rises you could do that would help to improve the operation and the efficiency of the tax system. There's also lots of tax rises that you could do that would make the tax system worse. So we've seen chancellors announce tax increases like the insurance premium tax, or take away on pension contributions for high-income individuals, or increases in stamp duty. They were the kind of measures that Mr. Osborne, Mr. Darling and Mr. Brown went for that really aren't helping the operation of the tax system. So if you want to raise a significant amount of money, you could certainly do worse than just announce an increase in the rates of one of the main taxes: income tax, national insurance, or VAT. Now, income tax is a tax where we don't seem to announce rate rises very often, at least not the main rates. They haven't been increased since the 1970s. Rate increases in VAT have occurred, but are explicitly ruled out in the Conservative Party manifesto. So maybe that leaves national insurance contributions as the obvious option. And I note that the Conservatives increased NICs in the early 90s, Labour increased it in the early 2000s, and the Coalition increased it in the early 2010s. So following that pattern, maybe we'll see an increase in the early 2020s. Another way to try and boost tax revenue significantly without announcing a tax rise is to cancel a pre-planned tax cut. So in April 2020, on current plans, the rate of corporation tax is to be cut from 19% to 17%. Now, cuts to corporation tax are always nice if you can afford them, but cancelling this cut would boost revenues by about £5 billion a year. The problem there is that to do so would require a vote in the House of Commons, so the cut to 17% has already been passed, and it would also break a Conservative Party manifesto to deliver this cut as is currently planned. So perhaps we can decide that significant tax-raising measures are very unlikely, at least in this fiscal event. The politics seems to make any significant tax takeaway very difficult. And that the one exception to that might be a package of tax avoidance measures. These are traditional in budgets now. Since 2010, we've had over 100 measures which have been claiming to crack down on tax avoidance. Now, I'm not saying that you shouldn't have tax avoidance measures in budgets. They can often be the right thing to do to adapt to the changing situation. But one lesson learned is that we need to be very careful about banking the money that we're going to get from them. Those 100 measures or so that have been implemented since 2010 are estimated on their initial costing to be raising over £10 billion a year in revenue now. But the OBR has gone back and looked at some of those costings and looked at the evidence since the measure was implemented and has decided that some of the bigger tax-raising measures in this category have actually failed to deliver the revenue that was hoped for. So Mr. Hammond certainly shouldn't be convinced he's going to get the revenue that he expects from these kinds of measures. At the very least, he must acknowledge that they're highly uncertain. So that's all the takeaways I'm going to talk about. I'm now going to talk about possibilities for giveaways. There's clearly been a lot of debate in recent weeks about options for the Chancellor easing off on austerity. So let's suppose he goes down that route. What are his options? Well, one possibility is to announce tax cuts. If you're in favour of tax cuts, you'd probably point to the fact that there's already a £6 billion net tax rise in the pipeline, still to come. And indeed, as Tom showed you, the tax burden is forecast to rise to a level that the UK has not maintained since the 1950s. If you want to go for tax cuts, what might you do? Well, the Conservative manifesto contains a commitment to increase the income tax personal allowance to £12,500 and the higher rate threshold to £50,000 by 2020. And indeed, the DUP manifesto also supports increases in the income tax personal allowance. Now, because the Coalition and Conservative government have spent so much money increasing the personal allowance so far, and because inflation has turned out higher than expected, that means we're getting pretty close to that £12,500 already. Going the whole hog and meeting both of these targets would now only cost an additional £1.1 billion a year. So that would be on top of the £12 billion that we've spent increasing the personal allowance since 2010. Another measure which I'd guess is highly likely in the budget is announcing yet another freeze to the rates of fuel duty. It's now traditional to assume that fuel duties every year are going to go up in line with the retail price index, but to cancel the next increase each year. So as an annual tradition, we cancel the increase that's about to come. Doing that for a further year would cost about £750 million, and that would come on top of the £5.4 billion that's been spent on freezing duties since 2010. Now, having policy where you announce a change every single year is not the right way to run your tax system. You want to deliver certainty to taxpayers as far as you can. So we should decide what we want to do with these revenues. We should also acknowledge that fuel duties are an important source of government revenue that's fast being eroded, not just by this policy, but also by increased fuel efficiency of vehicles. So there's some decisions here. One option might be to choose to freeze for petrol but not diesel. The latest evidence suggesting that diesel emissions are more harmful than we initially thought. So you would open up a differential in those rates. Doing that would cost £250 million a year rather than £750 million a year. Another possibility would be to move away from saying that fuel duties are going to go up each year in line with the retail prices index, which is now a discredited measure of inflation that tends to overstate household inflation. You could, for example, say that in future it's going to go up in line with the consumer price index. That would be a giveaway relative to the plan of increasing in line with the RPI. But of course, if you were able to carry it out and actually increase rates in line with the CPI, that would get you more revenue than a policy of every single year announcing another one-year freeze. What about benefits? Well, one possibility is to announce an increase in working age benefits compared to the current plans. And if you were in favour of that, you'd probably point to the fact that there were £12 billion of cuts to benefits working their way through the pipeline, and that's on top of the £29 billion worth of benefit cuts that have been implemented since 2010, which have also largely affected working age families. One part of this, which has got lots of attention in recent weeks, is the rollout of universal credit. So by September, rollout of that policy had reached about 8%. By March, it will reach 13%. Lots more areas starting to implement universal credit in the current month. Now, there are winners and losers from universal credit, but on average, it's less generous than the system it's replacing. If you're an existing claimant, you will continue to receive the same, and you would lose under universal credit. You actually get the same amount in cash terms until UC awards catch up with your entitlement. But if you're a new claimant or if your circumstances change, you can end up on a less generous system. There's also been a lot of concern about the amount of time claimants can face before receiving their full payments. Many claimants were having to wait 6 weeks before they receive the full amount. Now, part of this is just the way that universal credit is meant to be operating. You make a claim for universal credit. If that claim is approved, your income is then assessed over the subsequent month. At the end of that month, we know your income, we work out what universal credit you're entitled to, and that is then paid. That's an intrinsic part of the design of universal credit. On top of that, if you're unemployed and seeking work, if you've just become unemployed, you have to wait 7 days before you can put a claim in for universal credit. You're not allowed to put one in straight away. Now, that was a policy decision made in the spending review of 2013. Under the previous job seekers allowance system, the waiting days period was 3 days, not 7 days. One option would be to return to a 3-day waiting period, or you could even go further if you wanted, but returning to 3 waiting days would cost you about £0.3 billion per year. As Tom mentioned, the most significant new policy that's coming in that's making the benefit system less generous is the freeze to the rates of most working age benefits. So that's a 4-year policy. We've had 2 years of that. We've got 2 years to run. So most working age benefits under current policies would be frozen in April 2018 and April 2019. The original costing when this was scored was that this would save £3.4 billion per year. Inflation has risen faster than expected since then, in part because of the depreciation of the pound following the EU referendum. And that means that the policy is now expected to save £4.6 billion a year, about a third more than was initially intended, and therefore households are seeing their income squeezed by more than was initially intended. And this is a problem of when you announce nominal targets for policies, either in the tax system or the benefit system. If inflation subsequently turns out different to what you expected, you're going to affect the public finances and household incomes in a different way to what was your intent. If the Chancellor decided he wanted to keep to the original costing, he could, roughly speaking, decide not to freeze benefits for the next 2 years, but instead increase them by 1% a year, or he could cancel the final year of the freeze. That would still get him the £3.4 billion that was initially being planned for. Or he could go further, he could scrap both years of the freeze that are intended, return to CPI indexation. That would cost him around £4 billion a year, so clearly a significant sum of money compared to the current policy. And the final area I want to look at is spending on public services. If you were in favour of increased spending on public services relative to current plans, you'd probably point to this. This shows you how much central government is spending on the delivery and administration of public services in terms of day-to-day spending, so it's ignoring investment spending, it's looking at the bulk of public spending that goes on things like wages and salaries. And you can see that in real terms, it was cut pretty sharply between 2010 and 2012, and then is being cut at a slightly reduced pace since then, and that's forecast to continue sort of 2019-20, at which point the government plans then imply a real freeze to this component of spending. But over this period, the UK population has been growing. For many public services, that means additional demands. So, for example, it puts additional pressures on schools and hospitals. If we look at real-term spending per capita, therefore, because the population has been growing, we can see that that has been cut more sharply, and on current plans will continue falling throughout the rest of the forecast horizon. So per capita spending in real terms is set to fall by a further 5%, on top of the 13% we've already seen since 2010-11. So if you wanted to top up the spending plans by enough to stop per capita spending falling over the next 5 years, you'd have to find an additional £15 billion from somewhere. So what might you do? Well, one way in which the government has been able to cut public spending in recent years is through very tight control of public sector pay. And that's again an area which has achieved much attention in recent weeks. So the chart here is showing you the difference in the average hourly wages of public sector workers compared to the average hourly wages of private sector workers and how that's changed over time. So on average, public sector workers are paid more per hour than private sector workers. Now, in part, that can be justified by the fact that on average, they have higher levels of education. So for example, you'd expect a surgeon to earn a relatively large amount per hour. So we don't know what the right level for this line is, but it's interesting to compare the relativity over time. How generous are we being on average to public sector workers compared to private sector workers now compared to recent history? And what you can see is during the financial crisis, public sector workers' pay relative to private sector workers' pay increased quite dramatically. That was because the recession meant that private sector wages were depressed and the public sector didn't adjust to that. So the clawback we see in recent years has basically been about returning that differential to where it was around 2007-8. But what if we keep to the government's policy of indexing scales only in line with 1% for right the way through to 2019-20? Well, on the March forecast at least, we'd expect this differential to follow this line. It would go below the level seen before the crisis quite decisively, and in fact would reach a lower level than what we've seen at any point in time over the last 25 years. You could choose to do something else. You could choose to allow public sector pay scales to increase in line with the CPI or in line with forecast private sector earnings growth. Both of those policies would deliver a pretty similar outcome. They would see public sector pay relative to private sector pay stabilise at its current level. So an advantage of doing that is that you would be taking much less of a risk with retention, recruitment, motivation of public sector workers. The cost is, of course, going to be a much bigger increase in the public sector pay bill. So we think there'll be about £6 billion extra pressure on public spending there. So if the Treasury did choose to relax the pay cap, they don't have a choice. Do we tell public sector employers, well, we've relaxed the cap, you can find the money from that from your existing budgets, or do we have to top up those budgets to provide them with the resources needed to pay for greater public sector pay than what policy's currently been set on? So, for example, would you really tell the NHS that they'd have to find additional funds from their budget to pay for higher salaries of nurses and doctors, or would you have to find greater resources available? £6 billion price tag, again, pretty expensive. So that's a kind of across-the-board way in which the government has squeezed public spending, and relaxing this public sector pay cap, if you then made money available to departments, would be an across-the-board way of increasing public sector spending. An alternative approach is for the Chancellor, for the government, to look at the areas of public services that are showing clear signs of strain and target any spending increases at those areas. Now, we have not done a comprehensive review of all areas of public services. What I'm going to do now is just present two different case studies where there's clear evidence that there are some signs of strain. So that's not to say these are the areas most under pressure, and it's not to say these are the areas where additional money would make the most difference, but I think they are indicative of some of the problems that departments are having after 7 years of austerity. And the first one I'm going to show is the NHS, which on the face of it you might think is a bit surprising. It's an area where the budget has actually been protected from spending cuts in recent years. But actually, the NHS is used to getting quite big increases. This shows for UK NHS spending the increase each year in real terms in per capita spending. So you can see occasionally we do squeeze spending, but often the NHS enjoys pretty large increases. And on average, over the period between the 1950s and the financial crisis, the average increase in per capita spending was running at about 4% per year. So since then, we've seen increases nothing like that, which perhaps means is not surprising that the NHS is starting to struggle. Now, going forwards, we don't have firm plans for UK NHS spending over the next 4 years, but taking the plans we do have and making some assumptions, we think the figures look roughly like this. You can make different assumptions and get slightly different figures, but the broad picture remains the case. The NHS is now currently halfway through its tightest funding period since the mid-1950s, and if anything, it looks like the funding increases over the next few years get a bit harder rather than a bit easier than the last 4 or 5 years. So what's happening within the NHS? Well, one thing we can look at is how much is the NHS doing. Now, if we take Department of Health spending in England, we can see that in 2016-17, that was 3.2% higher in real terms than it was in 2009-10. So that's how much extra resource has been given to the Department of Health in England. Now, we know that within that, they've cut back on central spending and they've allocated more money to frontline spending. But we can also see that activity measures have grown much more quickly. So again, looking in per capita terms, we can see that A&E attendances, we can see non-elective admissions, we can see elective admissions all growing much faster than the increase in resources that the NHS has received. So this is evidence, firstly, of the changing demographics putting greater pressure on the NHS, but it's also evidence that new technology and greater efficiency is potentially being employed in order to get the NHS to do more with the limited increase in resources that it's had. So in some ways, you could see this as a pretty good news story. The NHS is managing to do more than perhaps its budget increases would suggest. But if you look at some of the targets the government has set the NHS, you can see some clear signs of strain. So one target that's very high profile is the proportion of A&E patients in England who have to wait more than 4 hours. So the percentage who are admitted, transferred or discharged within 4 hours is shown by this line here, and you can see that that line is clearly moving downwards. And whereas under the Labour government, generally speaking, the NHS was meeting the target, they were set to have this figure at 98% or above, you can see we're now well below the 95% target that the coalition first set in 2010. And Jeremy Hunt this year has said that he wants to see the NHS meeting this target next year, and to do so would clearly require quite a turnaround in the way the data are moving, at least over recent months. Another indicator of quality is the percentage of patients who are having to wait more than 18 weeks after they've received referral before they start to get treatment. And again, these data are for England. And you can see that the percent of patients having to wait more than 18 weeks from referral to treatment dropped quite sharply during 2011 and 2012, but then has been increasing sharply since then. And again, this is an area where the government has a target. It says that no more than 8% of patients should have to wait more than 18 weeks. So this big increase since 2012 means that we're now quite a way ahead of that target. But on this one, I think it's important to put the data in a bit more of an historical context. If we draw exactly the same line and just extend the graph a bit and look to see what was happening before 2008, you can see actually the percent of people who are waiting more than 18 weeks was far, far greater. So while it is true to say it's increased dramatically over the last 5 years and it's running well above target, it's nowhere near the levels that we were seeing in 2007 and the early months of 2008. So the other area of spending I want to focus on is what's happening in prisons, and for this I'm going to draw on some excellent data that were pulled together by the Institute for Government, looking at both spending, staffing and some potential measures of service quality within prisons. So in terms of prison spending, in real terms, we're currently spending about 20% less than we were in 2009-10. And prison staffing numbers have been cut by about 25% over this period. And in terms of the demand on prisons, you can see that the prison population hasn't been falling. If anything, it's slightly higher. So prisons having a reduced budget, they had to cut back on the number of staff that they employ, and they're having to deal with a slight increase in the size of the prison population. So the indicators that the IFG have managed to pull together show what's been happening to assaults on prison staff, assaults on prisoners, and cases of prisoner self-harm. And you can all see that these have increased very dramatically since 2012 and are on very, very steep upwards trajectories. So clear sign of pressure within the prison service. And this area is particularly interesting because it's one of the very few areas that Mr. Hammond decided to allocate extra money to last year in his autumn statement of 2016. And it's also one of the very few areas where the cap on public sector pay has already been lifted. So the pay cap for the 1% pay cap for prison officers was lifted a few weeks ago. So to conclude, it's pretty clear that Mr. Hammond is in a difficult situation. The budget is not going to be easy. We have got a deficit that's now back to pre-crisis levels, but public sector debt is far, far higher than what it was before the crisis, and the government wants to reduce the deficit further in order to get debt down more quickly in future. But doing the austerity that's already planned, the tax rises, the benefit cuts, the public service cuts, given that they're coming on top of 7 years of austerity so far, looks increasingly difficult to do. It also looks tricky politically, and all of this comes on top of the uncertainty around Brexit. We don't know what kind of Brexit deal we're going to get. We certainly don't know what effect that's going to have on the economy or the public finances. Now, as Tom showed you, if the OBR was keeping to its March forecast for productivity growth, then our analysis suggests that the outlook for the public finances in broad terms wouldn't really be changed. If anything, it would be slightly stronger. So in that world, Mr. Hammond could have confirmed all of the giveaways announced since March, perhaps added 1 or 2 more, and still left borrowing on course to be at the same point as he thought just 8 months ago. But the likely productivity downgrade would, if it's significant, dominate the fiscal arithmetic. So if the OBR decides it's going to downgrade its productivity assumptions halfway between what it thought in March and what experience over the last 7 years suggests, well, that would add about £20 billion to the deficit in 21-22. It would increase it from current forecast of £17 billion to around £36 billion. Now, if that happened, the Chancellor could still stand up and say, all my fiscal targets for this Parliament are on course to be met. Of course, the amount of headroom he'd have against those targets would be much reduced. So about half of his headroom against his 2% limit on structural borrowing in 2020 would have been used up in just 8 months. So what's he going to do? Well, it seems highly unlikely he's going to announce a significant fiscal tightening, further tax rises, further benefit cuts, or further public service cuts on top of those already planned look pretty unlikely. So we're probably more in the world where we're going to hear about budget giveaways, but if we do, I think it's important to bear in mind that this will not represent an end to austerity. There's £6 billion of tax rises in the pipeline. There's £12 billion of welfare cuts in the pipeline. If you wanted to not be cutting day-to-day spending by central government on public services in per capita terms, you'd have to find another £15 billion there. It seems that it would take a remarkable turnaround for the Chancellor to decide he's going to offset all of that. So he's going to have to make some difficult choices, and if he's looking to increase public spending, choosing between the competing demands is going to be very difficult indeed. And finally, I think we can say that the chances of eliminating that deficit any time soon, well, that keeps receding. The 2015 manifesto told us it would happen in 2019-20. A year ago, Mr. Hammond said it would happen at the end of the next Parliament, which I note now is 21-22. The Tory party manifesto tells us it's going to be the middle of the 2020s. Now, it is possible we will get a positive shock to the public finances. We should all hope for that. In which case the public finances could perform better than expected and we could end up with a surplus. It does happen every so often. But perhaps it's time to commit to admit that a firm commitment to running a budget surplus every year from the mid-2020s onwards is no longer sensible. Thank you.